Hope everyone had a good week. This is episode 3 of the $100 to $10,000 series, where I invest $100 on a monthly basis to show everyone that investing doesn't have to be complex mumbo jumbo and that anyone can start making their money work for them. It's been a very volatile week for the stock market, with the market reversing much of its gains earlier in the week, as Fed Chair Jerome Powell said that there is uncertainty on how long it will take the American economy to recover. Let's take a listen.
This downturn is different from those that came before it. Earlier in the post-World War II period, recessions were sometimes linked to a cycle of high inflation followed by Fed tightening. The lower inflation levels of recent decades have brought a series of long expansions, often accompanied by the buildup of imbalances over time. Asset prices that reached unsupportable levels, for instance, or important sectors of the economy, such as housing, that boomed unsustainably. The current downturn is unique in that it is attributable to the virus and the steps taken to limit its fallout. This time, high inflation was not a problem. There was no economy-threatening bubble to pop and no unsustainable boom to bust. The virus is the cause, not the usual suspects. Something worth keeping in mind as we respond. While the economic response has been both timely and appropriately large, it may not be the final chapter, given that the path ahead is both highly uncertain and subject to significant downside risks. Economic forecasts are uncertain in the best of times, and today the virus raises a new set of questions. How quickly and sustainably will it be brought under control? Can new outbreaks be avoided as social distancing measures lapse? How long will it take for confidence to return and normal spending to resume? And what will be the scope and timing of new therapies, testing, or a vaccine? The answers to these questions will go a long way towards setting the timing and pace of the economic recovery. Since the answers are currently unknowable, policies will need to be ready to address a range of possible outcomes. The overall policy response to date has provided a measure of relief and stability and will provide some support to the recovery when it comes. But the coronavirus crisis raises longer-term concerns as well. The record shows that deeper and longer recessions can leave behind lasting damage to the productive capacity of the economy. Avoidable household and business insolvencies can weigh on growth for years to come. Long stretches of unemployment can damage or end workers' careers as their skills lose value and professional networks dry up, and leave families in greater debt. The loss of thousands of small and medium-sized businesses across the country would destroy the life's work and family legacy of many businesses and community leaders, and limit the strength of the recovery when it comes. These businesses are a principal source of job creation, something we will need sorely as people seek to return to work. A prolonged recession and weak recovery could also discourage business investment and expansion, further limiting the resurgence of jobs as well as the growth of the capital stock and the pace of technological advancement. The result could be an extended period of low productivity growth and stagnant incomes. We ought to do what we can to avoid these outcomes, and that may require additional policy measures. At the Fed, we will continue to use our tools to their fullest until the crisis has passed and the economic recovery is well underway. Recall, though, that the Fed has lending powers, not spending powers. A loan from a Fed facility can provide a bridge across temporary interruptions to liquidity, and those loans will help many borrowers get through the current crisis. But the recovery may take some time to gather momentum, and the passage of time can turn liquidity problems into solvency problems. Additional fiscal support could be costly, but worth it if it helps avoid long-term damage and leaves us with a stronger recovery. This trade-off is one for our elected representatives who wield powers of taxation and spending.
Markets did climb back up in the last 2 days of the market open, but the S&P 500 still ended negative for the week, and our gains are down to 1.56%. And as mentioned before, this is completely normal when you invest in the stock market, as everyone's views on companies change on a daily basis because human beings are fickle creatures. Nonetheless, what is important is to continue investing through this downturn and be consistent with your investing strategy. This week, I was helping one of my friends start their investment account, and they asked me if they should buy Coca-Cola stock because it seems so cheap compared to other stocks. When I asked them how they came to that conclusion, that Coke was trading at a cheaper price, they said because the stock is only $40 per share, whereas the S&P 500 ETF is trading at over $200 per share. So in their mind, Coke was 5 times cheaper than the ETF. Now there are a couple issues with this view. First is that Coke is an individual stock, whereas the S&P 500 is an ETF. They are two completely different animals, and it's like comparing the weight of an adult versus a baby. It is normal for an adult to weigh 150 pounds, but if a baby weighed that much, it would make headlines. In a similar sense, it doesn't really make sense to compare one company versus a fund, which holds a bunch of other companies. So the first thing you want to do when comparing two different companies in terms of relative value is to make sure that the companies that you're looking at are the same type of investment and that they are in the same sector of business. So instead of comparing Coke to the Vanguard ETF, you might want to consider comparing Coke to Pepsi. The second thing to note is that an individual value of a stock does not really mean much. What you should be looking at is the market cap of the company, which is basically the value of the company based on the market value of its shares. And the formula for this is really simple to calculate. Take the value of one share of the stock. So for Coke, it was $43.26, and then multiply that with the number of shares outstanding. This is the number of shares that are available for trading in the stock market. This number can change if the company decides to do what are called stock splits, but I won't go into too much detail in this video. So the number of shares outstanding for Coke is 4.29 billion, and multiplying that with $43, you get $185 billion of market cap for Coke. Comparing that to Pepsi, Pepsi last traded for $135 with 1.39 billion shares. So even though each share of Pepsi costs about 3 times more than one share of Coke, there are less total shares available to trade. So its market cap ends up being about the same at $188.6 billion, about 3 billion more than Coke. If you guys would like more in-depth analysis, let me know down in the comments and I can work on that video for you guys. Moving on to big news items for the week. Uber announced that they are planning to acquire Grubhub in a deal where Uber will pay Grubhub 1.9 shares of Uber for 1 share of Grubhub. And both Uber and Grubhub stocks rose sharply in the middle of the week as analysts saw this potential merger as being good for Uber by eliminating another competitor of its lucrative Uber Eats business, as well as acquiring Grubhub's know-hows as a dominant player in the food delivery service. But Grubhub wants Uber to pay up 2.1 shares of Uber for 1 share of Grubhub instead. This may seem petty, fighting over 0.2 shares, but you have to understand that Grubhub has almost 92 million shares outstanding. So, multiplying 0.2 shares with 92 million is 18.4 million shares of Uber, and each share of Uber costs $32. And so if Uber is able to get this deal for 1.9 shares instead of 2.1 shares, they would save $588 million. Now, some analysts voiced concern about the deal as the combination of these two giants would create a company that has over 50% market share of the food delivery sector, especially in larger cities where these apps are the most popular. And we all know if a company has too much control and not enough competition, it's bad for everyone, with higher fees for customers and less motivation to innovate for the company. Moving on, have you guys heard of CPI? It stands for Consumer Price Index, and it's a measure of the average change over time in the prices paid by urban consumers for a market based of consumer goods and services. These indexes help an investor determine the impacts of current events on consumer spending behavior, and helps us to gauge how the price of goods are changing and by how much people are spending their money differently. Looking at the past 12 months from this April, food prices have gone up 3.5% year over year, and energy prices have tanked 17%. This makes sense with what's been going on as people are stocking up on essential items like food, but not leaving the house or traveling, which brings down energy prices. And car rental rates have also tanked in April as it saw gradual lower numbers over the past few months, but in April it dropped a massive 17%. And so large car manufacturers have been reflecting this fall as shares of Toyota, which has the largest market cap among the auto manufacturing companies, fell by about the same 17% since its highs. And the Health and Economic Recovery Omnibus Emergency Solutions, or HEROES Act, passed the House this Friday with the rumored $2,000 reoccurring stimulus check being removed from the bill and instead replaced with another one-time stimulus check for $1,200 for individuals, $2,400 for joint filers, and $1,200 for up to 3 dependents. The Paycheck Guarantee Act also did not make the cut, which would have covered up to $90,000 in wages of workers. The act pledges $1 trillion to state and local governments that have lost revenues from sales taxes and $200 billion to essential frontline workers as hazard pay. Thank you guys so much for watching, and if you guys enjoyed the video and want to see better videos from me, please don't forget to hit the like and subscribe button with the notification bell, as your support does encourage me to make better content. Thank you guys, and I'll see you guys on the next one.